Good morning, everyone, and welcome to this Easy Equities webinar with CoreShares. I'm your host again, Sean Keeling, and today we're joined by Michelle Noth, who is the client coverage executive at CoreShares Asset Management. It's nice to have Michelle on the call. It's nice for a change from Chris or Zizi, so welcome, Michelle. Today, Michelle will be chatting to us about how you can trade offshore via the JSE. So Michelle will unpack some of the offshore ETF exposures available on the JSE and explain exactly how they work. So thanks so much again for joining us, Michelle. And thank you to all of you for taking your time out of your day to join us. We know sometimes it's really hectic with work, especially people going back to work these days, so we really appreciate it, and we hope you can find this session informative. Just a reminder that if you are looking for more information around ETFs, please do check out our Easy ETFs platform. That's at easyetfs.com. And also, if you're looking for a recording of this webinar, it will be sent to you, but it will also be loaded on the webinar page at Easy ETFs. We have been doing a series of webinars with CoreShares if you've missed them over the past month, and that is also loaded on the page, so make sure to go check them out there. Just before I start, I just want to hear and see if everyone can hear me. If you can hear me, please just raise your digital hand. Thanks a lot, guys. I see some hands going up there. And please just also ask questions as we go in the questions box. Michelle will get to them after the presentation, but if you have anything, just pop it in the box and we'll get it all to them. Enough with me talking. Over to you, Michelle.
Thank you, Sean. It's really great to be here, and thanks to all the attendees for dialing in. It's so great. We're really enjoying this series of webinars with Easy Equities, because I think both CoreShares and Easy Equities are equally passionate about bringing, low-cost, effective tools to South Africans. And in South Africa, I think we can really be grateful about all these incredible investment products that we've seen over recent years, and just giving us so much more choice and so many low-cost ways to take care of our futures. And as Sean mentioned, there have been some other webinars before. The first one was called What is an ETF? The second one was called What is an Index? And the last one with Chris Rule was actually just unpacking how do you identify your financial goals and then figure out what investments are suitable. So yeah, really, it's really nice to sort of go from the very beginning. And then today to talk about the offshore, how to trade offshores, quite simply, while sitting here via the JSE. So I'll just take 1 minute to recap on, how we got to this point from the previous webinars. So, just to recap on what are the benefits of passive investing. So passive investing, index investing, a lot of the ETFs are tracking index strategies. So, why is this so useful to investors? So firstly, the returns are really competitive. So there's lots of academic research that's looking at, are you getting good outcomes by investing in just purely index strategies? And it's the evidence is very compelling. And that, very few active managers are actually managing to outperform these benchmarks after the fees that they charge. And then secondly, the low cost of these products. So it's really making it's very easy for investors to access investments and these exposures for very low costs, which actually help you in the long run, because if you're paying lower fees, you're getting more returns. And thirdly, index products and ETFs are very transparent. There's very good governance. It does what it says on the tin. If you invest in an S&P 500 ETF, there are the 500 biggest companies in the US in that fund, and you have confidence that what you chose to invest in is actually what the fund manager is doing. And lastly, diversification. So it's really hard to pick one or two shares, and the safer way to do that is really if you invest in a whole index or a whole basket of shares, if something happens to one of those companies, if you have a Steinhoff incident or one of these these corporate problems that happens to one company, it's not going to affect your overall performance very much, because it's only a very small part of your basket. You've got lots and lots of other companies in there to make sure that you've got a good representation of the market. And just to have another look at SPIVA. So SPIVA is the S&P index versus active. So this is academic research which is performed by an index provider called S&P. And in a previous webinar, we looked at how South African active managers perform. So here we we're just looking at some of the offshore performance. So this is specifically looking at the US, for example. How do active managers that are trying to pick stocks in the US fare compared to just a very well-known benchmark like the S&P 500? And here that you can see almost 80% of those managers, so 77.97%, cannot outperform the benchmark after their fees. So that means if you're trying to invest in US companies, have an exposure to the US market, if you use an index like the S&P 500, you can know with confidence that you're going to do 80%, you're going to do better than 80% of those active managers that are out there trying to, with teams of analysts trying to pick shares, which is quite compelling when you look at these numbers. And then another sort of recap from a previous session where Chris was talking about, how to choose how much to invest offshore, or whether to invest offshore. This was just a nice way to see how does South Africa actually fit in to the global investment opportunity. So based on all the companies that are trading on all the exchanges all over the world, the market cap in South Africa is less than 1%, so 0.7%. Is the value of all the companies on our exchange locally. So if you're only investing locally, you're not really getting a very broad access to the whole global growth story. And that's really, it's not to say you have to take a view on whether you think the South African government's doing a good job or whether you think our economy is going to do better or worse in the next year than it has in the last year. It's simply saying, I want to have a more diversified exposure to the global growth story and to what all these amazing companies are doing all over the world, of which South Africa is really only a very tiny portion. And so let's look at the mechanics of what's available on the JSE and how does that actually enable you sitting here in South Africa with your rands to invest in offshore companies. So again, I'm going to just stick with the S&P 500 example for simplicity's sake. So here's our investor sitting here with their rands. So then they open an account with, for example, EasyEquities, their stockbroking account. They put their rands into that account. And then you place your instruction, and EasyEquities then send your money to the JSE, for example, to buy something like, a CoreShares S&P 500 ETF. And that money goes to the JSE, and in exchange, you get ETF units back. And then from the JSE, that money goes into our fund in this example. So your rands are arriving into the CoreShares S&P 500 ETF, and our portfolio manager then goes and buys dollars, so changes your rands into dollars, and then uses those dollars to go and buy all the underlying, exposure, those 500 biggest US companies. So from your perspective, it's very simple. When that ETF pays out dividends, you receive those dividends back in rands. But it's just like buying any other share that's listed on the JSE from your perspective. So there's, the funds, the ETF manager, our portfolio manager is, changing your rands into the various currencies. And if it's a global benchmark, they would then, change it into all the various global currencies and go and buy those companies around the world for you to own in your fund here. And that brings me to another very important point that you need to understand if you're buying offshore exposure and that's listed locally on the JSE and rands. Your performance is going to be made up of two things. So it's both the performance of that actual offshore investment, as well as any change in the USD ZAR exchange rate or ZAR versus hard currencies or whatever the underlying currencies are. So just to give you an illustrated example of how that plays out, here is a very long, 20-year history since 2000 of the S&P index on its own is the navy blue line. So that's what the US stock market, the 500 biggest companies in the US, how their performance looked. And then this pale blue line is the USD ZAR, and the dark red line is actually, so how does that look for me as an investor, as a ZAR denominated investor? So it's the S&P 500 in ZAR. So it's a combination of the US equities growing and the price increasing over time, plus the rand, slowly depreciating over time. And then the combination is this, wonderful performance that you see there. And you know, keep in mind that this is the long-term view. As you can see, these lines are very ziggy and zaggy. So I want to also show you how that looks, you know, over shorter time horizons. So, you know, the rand is an incredibly volatile currency. So you need to sort of understand that you're going to be exposed to that. So on the left here, you can see the rand, the USDs are over 10 years. So there's quite a lot of, you know, zigging and zagging, but it's very clear that that trend is a firmly upwards sloping red arrow. Whereas if you look at a shorter time horizon, like on the right-hand side, that's the US dollar versus the rand over the last year. And obviously the last year has been particularly volatile, but it makes it a good example for that reason. And it's really not clear, you know, whether you could expect at any one point in time that the dollar is going to get stronger or weaker looking at this graph. So that's why it's, you know, and what also tends to happen is that South African investors, when things get really bad and the rand gets really weak, that is when we tend to panic and say, oh my goodness, I need to put all my money in an offshore exposure. And so what can happen, for example, if you panicked in March of this year and you said, oh my gosh, I have to put all my investments 100% offshore, you would have been buying dollars at around 19 rand to buy $1. Whereas now it only costs around 15 rand to buy $1. So if you change your rands into dollars and bought offshore investments, you know, around about March, April this year, even if those offshore investments hadn't changed in value, let's, you know, assume for an academic purpose that they've just stayed completely flat, whatever it was you invested in, you know, you would have lost around 20% of value by now simply because the rand has strengthened. So I think the purpose of this example is not to scare you off about investing offshore, but it's just to make sure that you're prepared to and understand the fact that the rand is a very volatile currency. If you invest offshore, you're going to be exposed to that fluctuation, but you need to keep this in mind, that over the long term, the rand tends to depreciate versus hard currencies because we have a higher inflation rate here. And that's something that's been very well documented. That's part of the reason for investing offshore, but you need to be prepared to, you know, withstand some of this volatility on the right-hand side here. And, you know, also it's part of the decision for choosing an offshore investment for the right purposes. So if you, for example, planning to buy a house in 1 year's time and you've been working very hard to save up your deposit and you think, okay, I'm going to invest my deposit now so that it could just grow a bit, because in 1 year's time, I'm going to then take it out of that investment and buy my house, that would be a bit nerve-wracking, because if you invest in something like offshore, as we can see on the short-term horizon, you know, it's very possible that the rand can either strengthen or weaken by 20% in a 1 year period. Those are huge moves. So that's why it tends to be really, really more of a longer-term time horizon, or a nest egg, that you're not living off the dividends. So it's not you're in your retirement and you're really counting on the dividends from month to month, because that's what you use to buy your groceries and pay for your petrol and pay for your MTN and all of that, because there's this fluctuation because of how volatile the rand is. So that's really the point that I wanted to make here. But, you know, in the long term, obviously, that's exactly what we want. We want to have exposure to hard currencies because we want, you know, that wonderful red line that's outperforming there. So I hope that was clear. And now to talk about some examples of the specific ETFs that you can use that are on the JSE. I work for CoreShares, so obviously I'm going to talk about examples from the CoreShares range, but there are really many more, and we're very, very fortunate to be getting more and more choice in South Africa. So let's start with the S&P 500 ETF. So our share code is CSP 500. As we've already mentioned, you're getting the 500 largest companies in the US economy. You're getting exposure to the US economy, and just this bar chart at the bottom here shows you the market cap of all the companies in the S&P 500 compared to this little sliver on the right, which is all the companies on the JSE. So you're just really getting a huge exposure to a very broad basket of big US companies. And this index has been around since 1957. It's really well established. There's $3.4 trillion globally invested in products that simply track the S&P 500. And just another point to mention, I mean, obviously in the US, there are large companies like Apple and Facebook and, all these companies that we know that are based in the US or they're headquartered in the US, but their sales revenue is actually from all over the world. So this is just a snapshot to show you that when you invest in the S&P 500, you actually are getting some, broader exposure to other parts of the world because, Facebook is not only generating revenue from people in the US, etc. And this is just to kind of pop the hood and have a look what's going on inside the S&P 500 index or inside the ETF. So the top 10 constituents of the 500, obviously I can't fit 500 on this page, but just to give you a taste, and the full holdings are available on our website. Apple, Microsoft, Amazon, Alphabet, Facebook, Berkshire Hathaway, that is Warren Buffett's investment company, the famous investor, and Johnson & Johnson, Visa, Procter & Gamble, Nvidia, etc. So most of these are really well-known big companies. And then the sector weightings, technologies had a really good run. And so, those big companies became bigger because their share price improved so much. So now the information technology sector weighting is actually sitting quite high at 28%. So that's a factor of something that's market cap weighted. So, you invest in the biggest companies by market cap weight. And if their share price increases, the percentage becomes more and more in the overall basket. But, very good representation across lots of different sectors here. And then, how do you find it? The share code is CSP500. It's on the EasyEquities platform. The TER is 33 basis points. So it's still, there's nice, cheap, passive exposure. You get the largest US companies, 500 of them. And the dividends are paid semi-annually. And the yield is based on the last year, the net historic yield is 1.3%. So that's a really, a really nice, simple example, a quick way to get access to the US economy for, a cheap price. Now let's look at an example, which is a global dividend. So we have something called the CoreShares S&P Global Dividend Aristocrats ETF. So S&P is the index provider. CoreShares is the fund manager. So our portfolio manager's job is to make sure that he is implementing and managing the fund in accordance with what S&P, the index provider, tells us. So, if anyone still needs to clarify exactly the difference between the index provider and the ETF issuer, I would encourage you to go back and watch one of the previous sessions. And so the S&P Global Dividend Aristocrats methodology, basically, it roughly matches the global spread of MSCI World. So you've got a really nice global allocation. But what it does is it then screens for shares that have got a long history of paying stable or growing dividends. So the idea here is that dividends or cash flow is a very good indication of the quality of a company. And this is, it's quite intuitive. Cash is the one thing that you can't fake. If there's a company that's doing very clever accounting and trying to hide losses, the one thing they can't fake is their cash flow. They can't, magically find some cash to pay out a dividend if their business isn't actually, solid and robust and generating cash. And so for that reason, we really like the strategy because it is such a strong indication of the quality of a company. And so what this methodology does is it looks for shares that have got a long history of paying dividends. If they drop their dividend, they get kicked out and they have to go back to zero. If they switch from paying a cash dividend to a scrip dividend, they get kicked out. They have to be paying cash dividends and they have to have a long history of it. And so what you get is this really nice, solid, diversified basket of very, very reliable, robust global companies. So the reasons why investors like this strategy is obviously this focus on quality income. So you're focusing on a company that can produce dividends and grow them over time, sustainable and predictable income for you as the investor. And what you're actually getting is, growth assets, because shares or investing in companies is a growth asset. They do grow over time, but it's a little bit of a defensive quality. So, you're not going to, this basket would exclude things like fast-growing IT companies, because they tend to reinvest all their profits into growing the business more. So these are more, mature and solid businesses that are not sort of investing and growing too much, but they've just already got a very reliable business model that generates a lot of cash, and they can pay that out to you as dividends. And these tend to be very disciplined management, very strong balance sheets, low debt levels. They're very selective on growth projects. And it's just a very nicely diversified basket. So you've got 346 global companies across 27 countries in this strategy. And how it all hangs together is basically it's an index of indices. So this global product invests in terms of how we come up with the shares that are in that is 58% of them are from the US. In the US, they have a 25-year qualification for the strategy. So a US company that's included in this benchmark has to have been paying stable or growing dividends for 25 years, which is really impressive. And then Europe, 18%, their hurdle is 10 years. Canada is a small allocation, 3%, with a qualification of 5 years. And Pan-Asia is an allocation of 21% with a qualification of 7 years. And it's quite nice in general, these regions, because you've got mostly developed markets, but you've got some emerging markets in Asia, which really is where most of the growth in emerging markets is coming from at the moment. So this product is really popular for that reason. And again, just to pop the hood and see what's actually in here, I can't fit 346 shares on the screen, but just to give you a little taste. These are really well-known names. These are companies that have been going. Their business is reliable no matter what the economy is doing through all the booms and busts. They keep, there's a lot of junk food on here actually, which is interesting. McDonald's, Domino's Pizza, Pepsi, Coca-Cola. There's nice household names like Procter & Gamble and Johnson & Johnson, chocolates, Nestle, Lindt. You can imagine that no matter how bad things get, you're still going to be buying food and buying washing powder and shampoo and all these kind of really reliable household products. We tend to call them consumer staples in the sector categorization. So this product is very overweight consumer staples. And yeah, just to look at the sort of key facts. The TR is 60 basis points, 0.6%, 346 companies across 27 countries. The dividends, again, are paid semi-annually. So all our offshore products pay dividends semi-annually. The share code is GLODIV, and the 1-year net historic yield is 1.5%. So a bit higher than, slightly higher yield than the S&P 500, as you would expect, with that focus on, on reliable dividends. And it's also, it's, for a lot of people, when they put their money or they invest in offshore exposure, it is a little bit more of a nest egg. It is a little bit more of a defensive view. So this benchmark or this index actually fits that use case quite well. And if you still do like the idea of reading the news and trying to find pick the next Facebook or pick the next Apple, or we do still like that idea of picking some US shares. You can take, for example, if you wanted to invest a certain amount of money offshore, you can invest 80% of that in something like this nice, reliable, solid benchmark product, and then still take the other 20% and go and pick individual shares. EasyEquities has a platform for that. You can trade US listed shares, and so there's really a lot of flexibility to just use these products as building blocks in a way that suits what it is that you're trying to do. And then the last example, so the two that I mentioned before are both equity benchmarks. So the S&P 500 is just your plain market cap weighted exposure to the biggest US companies. And then the global dividends is a global equity benchmark with a quality sort of filter to it. And then, you know, the final one that I'm going to talk about today is our global property ETF. Property is a very interesting one to talk about at the moment, so I'll sort of get onto a longer term view of it in a minute. But the global property ETF has 40 companies in it, 40 shares. It's the 40 biggest property companies globally, and this is how the geographic split looks. So it's 60% in the US, you know, a few in Europe there, UK, France, Germany, and then Pan-Asia, Japan, Hong Kong, Australia, and China. So a nice global global exposure there to the biggest property companies. And this is really the graph that I want to show in the context of talking about property. Obviously, property has been a very, very contentious topic, particularly South African property. And most of us just remember this blip on the right-hand side where we just see those lines plunging downward, falling off a cliff. But if you really zoom out and you look at the long-term performance, so this is since 2001, you know, that navy blue line at the top is global property. So these are all global exposures. So you can see, you know, USD cash at the bottom, then global bonds. You know, cash and bonds are, you know, difficult over the long term because they often don't keep up with or outperform inflation. So for a long-term view, we tend to want to be more in growth assets like global equity and global property. But I just think this graph is interesting to remind us actually over the last 20 years how much global property has outperformed compared to equity, and it's clearly a very difficult space at the moment. But yeah, it is good to remind ourselves why some people sort of choose to include it in a long-term, you know, investment view. And it does still have quite attractive yields, so higher than equity. So in this ETF, GL Prop is the share code, TER 63 basis points. You're getting 40 companies across 8 countries. Again, the dividends are paid semi-annually, and it's got a higher yield than those other 2 equity benchmarks at 2.3%. And you know, offshore investments always have lower yields compared to South Africa. In South Africa, we have a high prime rate, we have higher inflation, so all our yields tend to be higher here. But yeah, so it's good to, when you're looking at yields, compare them to other offshore yields. And that's really the sort of examples that I wanted to talk about today. This is just a summary of our JSE-listed ETF range. And Nick, in 2 weeks' time, I'm sort of still struggling with the fact that it's nearly December, but in 2 weeks' time, we're going to have another session looking at actually portfolio construction and looking at how do you combine some of these different exposures into a portfolio that reflects what it is you're trying to do or your long-term goals. And you know, for more information on these funds, please visit our website, CoreShares.coza, or you know, get in touch with me or Sean from EasyEquities directly. But yeah, I think now's a good time to open it up for some Q&A and discussion.
Thanks so much, Michelle. I really enjoyed that. I really enjoyed when you went into the funds and had a deeper look at them. You know, I find it very interesting and looking at the graphs. And I actually just really like the way you started that, talking about active and passive investing. And you know, it's always interesting because you always hear about how active managers do, and then with the DIY platform like EasyEquities using passive instruments, like you show you how you can actually do better than that. So it's better than them. So that's always really cool. We do have a few questions asking about if the session will be recorded. The session is being recorded and will be emailed to you, as well as it will live on the Easy ETF platform on our webinar page, and it will be up tomorrow. So you will get a recording. Don't worry about it. I just also had what I found very interesting about your presentation was when you spoke about the GlobDiv one and how long it takes for the US companies to be able to be represented on the GlobDiv. There's 25 years, so that just shows the level of how good the companies are, which is really interesting, producing dividends. While we wait for some questions to come up here, and guys, just hit us with anything you have. Michelle, in your presentation, you spoke about you have the historic net yield there on all the products. I don't know if you can go into a little bit more depth about exactly what that is and break it down for us a bit more.
Yes, sure. So that just means that is what we're going to pay out to you. So out of our fund. So basically, how it works inside ETFs with dividends is that you know, the underlying shares pay dividends all at sort of different times, and we collect that cash inside the ETF. And then we then pay that out twice a year. But before we pay that out, we deduct our fees. So so that's why it's net. So it's net of any fees from our side. That's actually how much the investor gets. But then again, on the investor's side, they need to obviously disclose that for tax purposes. So however that is going to be taxed on your side, we can't give you an indication of that because everybody's tax situation is different. But that's what we actually pay to you out of the ETF. I don't know if it was that enough detail.
Yeah, I think that was gave a good explanation of exactly what it is. Yeah, I just thought it'd be good to just play that. So thanks. And guys, are there any questions? We don't have any at the moment, so please just hit us up on them. And Michelle, you didn't put out anything on the companies that are in the global property one. Do you have a breakdown of the companies that are in the?
Yes, I do. You know, they tend to be not as well known, so that's why I don't sort of. It's not like a household name like Johnson & Johnson, but I do have the properties here. So that's again the kind of great thing about ETFs is everything is fully transparent. If you go onto any ETF issuer's website, you should be able to quite quickly find the full fund holdings. So, you know, I'll read to you here sort of the top ones from our website: Alexandria Realty, Boston Properties, Avalon Bay, Duke Realty, Essex Property, Equity Residential, Equity Lifestyle. I don't know if these are Simon Property Group. That one might sound more familiar. Sun Communities, Ventus, China Overseas Land, Daiwa House, Nippon Building Fund, Japan Real Estate, Mitsubishi Real Estate. Yeah, so these, you know, there's 40 like this.
Awesome. I didn't think we'd know them, but this is just cool to see. And like we say, they're listed on your platform, so it's great to people can go on and have a proper look if they want to actually go into depth on exactly what they are.
Yes.
So we have a question asking and saying, can we buy these shares from other portfolio managers besides EasyEquities? I mean, almost missed that question, but you know, it's always a good question to ask.
You're filtering questions, were you? Yes, I mean, the sort of ETFs are listed on all ETFs in South Africa are listed on the JSE, which means that anybody who has access to the JSE will be able to invest in these for you. So, you know, all the traditional kind of stockbrokers, if you have a stockbroker at you phone up and you have a chat to, they would also be able to access these products. And the same way as EasyEquities has lots of ETFs from other ETF issuers as well. You know, we're all very open architecture, so you know our ETFs are available through any platform that can access the JSE.
Thanks, Michelle. See, we have some questions coming in here. The first one here is saying, it's curious, is there a difference between making a lump sum purchase of an ETF or buying smaller amounts each month?
Well, you know, that's, you know, sort of, there's a lot of ways to look at that. You mean a difference in terms of costs or difference in terms of performance, or, you know, I think I want to go back to this graph here. This one here. I think, you know, it's really what suits you better. I mean, the thing with making a lump sum purchase is you might be buying it sort of at a good time, or you might be buying it at a bad time. We as CoreShares, we don't you know, we don't try and do market timing. We don't have a house view on trying to predict what the market is going to do in the next 6 months, or what the exchange rate is going to do in the next 6 months, because we really view investing as a long-term exercise. So you know, you need to kind of work out what your goals are. Is it that you want to retire in 20 years? Is it that you want to pay for your children's university in 20 years? Or is it that you're trying to save for a holiday in 1 year? You know, these kind of decisions are quite important as to how you approach your investing. And then, you know, it's never a bad time to start investing. So put it that way. It's always better to start now rather than wait for the perfect time, because you know, what makes the most difference to your investment is really how much you contribute to it over the long term. So yeah, I mean, in terms of the costs, not really. I mean, from our side, we charge a management fee, which is based on the assets that are actually invested. So how much we charge you for managing the ETF is apportioned to the size of your investment. So that wouldn't really make a difference to you if you invest a lump sum or slowly over time. In terms of the trading costs, it's also quite consistent. I don't know if there's minimum fees. Maybe Sean, you can jump in from the EasyEquities platform side. Is it less cost effective for them to put lots of little amounts in every month, or is it better for them to save up?
No, it's exactly the same as what you're saying, and I see there's actually a cost question also there, so we can answer it as you've been answering it. I mean, EasyEquities roughly charges 25 basis points per buy and sell. That roughly becomes 25 cents per 100 rand. So I mean, if you did 100 rand now, 100 rand later, it would all accumulate to the same cost from our perspective. So it doesn't matter on a cost lump sum.
Yeah, I mean, I think for a big institutional manager who's managing hundreds of millions of dollars, for them to make a lump sum investment into a particular exposure can sometimes, we would something like, for example, if the PIC decides they're going to put like $200 million into one particular index, the person who's going to execute that trade might advise them to break it up into smaller pieces, because it might actually move the market that it's so big. But in the sort of sizes that most, like you and me and all of us, are considering, I don't think there's really much difference. I think it's more the timing. So if you're worried about the rand dollar being very volatile, for example, I moved back from the UK a few years ago, and we had to kind of choose when to kind of move our pounds back into rands. Don't talk to me about it, because it would have been very different now than when I moved back a few years ago. But what we chose to do was just do it in bits, because we didn't want to do it all at once and then maybe the currency moved against us. So we sort of did it in little bits over time, just to try and get like more of an average sort of exchange rate, so that you don't just do it all on one day and get a bad exchange rate. But yeah, it's really up to you. I mean, I think if you're looking at moving things around, you may decide that you actually want to kind of move something and do it in one big clip, because you're busy and you don't want this to become like a 3-week project. And then after that, you're going to just set it up so it's your direct debit every month. I mean, I think it really is down to you and your lifestyle, because I think most of us here are not, managing money for a living, and we also have jobs and we have families and we have like lots of other commitments. So it's also just what is the most practical way for you to do it that's sensible in terms of how much time you want to spend on it.
100%. Thanks, Michelle. We have a question asking a little bit around TERS and how you collect your management fees. So if you can touch on that briefly for us, please.
Yes, sure. Okay, so let's just get on to one of the ones, for example. So, for example, here, the S&P 500, the TR is 33 basis points. So I think, regulation has tried to split out all these different definitions of fees in the interest of making it more transparent to investors. And sometimes it actually just makes it more confusing. But so let's sort of approach it from the point of view that it's meant to be helpful for us. So out of this, we've got a management fee out of that. And then part of that 33 basis points is also fees that we pay to other people. So fees that we pay to our custodian, and fees that we, audit fees that get done on the fund, and all of that kind of stuff. So that is, that's supposed to be the total expense ratio, the total amount of money that CoreShares is going to collect from your investment to go and pay all those third parties, and also to pay our management fee. The way that we do that is it's actually apportioned on a time, based on a time a sort of time basis, and also the AUM basis. So that 33 basis points would be sort of dripped off the value of your ETF every day over the whole year. It doesn't come as an annual charge. You wouldn't actually see it. It just gets sort of drip fed off the value of your NAV day to day, or the price of the ETF day to day. But then from the cash flow perspective, as I mentioned before, when the dividends are accumulated in the ETF and the underlying shares are all paying dividends, we then take our fee out of that and then distribute the rest to you. So there's sort of the accounting method and then the cash flow method. So the accounting method is you're never going to see annual charge. So that means that exactly how much you invest and for how long you invest, you're going to be charged the perfect amount that you're supposed to be charged. If that sort of helps reassure you, it's not that like you need to make sure you sell it on a certain day because that's the next day is the day we take the annual fee or something like that. Does that explain it?
I think it does. Thanks a lot, Michelle. So yeah, we got a good question. Just clarifying that does an ETF TER include the management fee? Sorry, the plane
Yes,
going over me. Yeah, so yes,
it does. Yeah. So what's not included? So that TER is everything that CoreShares is taking from you in terms of fees, as I said before. What is not included in that is what you're going to pay when you buy and sell that ETF. So that's what Sean was saying before. So EasyEquities has got sort of commission as you do for any time you trade on a share or anything on the JSE, and they've got their sort of whatever it is, their annual platform fee, which would be the same for whether you use an ETF or a share, I presume. And then if you're getting any advice, if you have an advisor or anyone like that, so you pay that on top. So that's all not included in that TER, but everything to do with what CoreShares is charging you for or spending money on, that's all included in that TER.
Yes, that's correct. On the EasyEquity side, I mean, no annual. Just to clarify on what Michelle was saying, there's no annual management fee. There's just when you purchase or sell the instrument, there's 25 basis points on that we take off, which is roughly, like I said, 25 cents per 100 rand. We have a question, Michelle, talking about what's the minimum amount that you can invest in an ETF property and where can they get started. So I'm just going to go before you go here. We've recently launched an Easy ETF platform. That's easyetfs.com. And for instance, if you're looking at the CoreShares Global Property one, there's a page that explains the CoreShares S&P Global Property ETF in depth. It goes into the pricing, all about the instrument, its returns, when paid dividends, and they've got links to fact sheets and blogs. And as well as, if you look, like Michelle said, if you go and look at the CoreShares website and analyze the instrument page, there'll be lots of information around it. And with regards to minimums on EasyEquities, there are no minimums. You can invest with as little as 5 rand, and buy a fraction of the ETF actually.
Thanks, Sean. Yeah, that's really so progressive. I think that's a really great development that you guys have done on your side.
Thanks, Michelle. We've got another question here, and I'm just going to read it as I go. It says, your CSP yield is 1 and 3, globdiv 1 and 5, and globdiv 2 and 3. Does the risk on CSP mean that in good times the yield would be higher? Why wouldn't we just buy global prop?
Okay, that's a good question. The yield is a function of how these figures are calculated is 1 year net historic yield. So it means we've looked at all the dividends, the total sum of the dividends that we've distributed over the last year, and it's divided by today's share price. And that's how you get this percentage, which is helpful because it's kind of the only method that we have. But it's it's less helpful in some ways because firstly, it's not projecting. It's not telling me what the yield is going to be in the next year going forward. So it is backward looking, like so many of our metrics. And also it's based on the share price. So for example, global property hasn't had as much of a rebound as S&P has this year. So sort of based on that, S&P's share price is probably higher compared to a year ago than what global properties is. So if you have a lower share price, it makes your yield look higher. So I think in terms of just deciding what to invest going forward, I mean the yield characteristic of global property is more attractive if you are somebody who is who relies on the dividends and needs to have that income. But you may not have the same growth in the share price, for example. So there's different outlooks there in terms of the total return. The total return of your investment is got two components to it. It's firstly the dividends that you received, which is the yield, but also the change in the share price. So there's also a kind of a view there on if you think property is going to perform better in the next year or the S&P 500 is going to perform better in the next year. So there's all these sort of, going back to the diversification, it's not an either or. You can put some in one and some in another. You could put some of your investment in S&P 500 because you really like the fact that it's got 30% exposure to, you know, those big IT companies in the US. You know, these are all decisions that you can make. These are sort of the reasons that some investors like these products. And you could, you know, and some investors would say, I definitely want to include an allocation to property because that higher yield is very attractive to me, and I want to, you know, the dividends are important to me. It's more important that so yeah, I don't know if that's helpful, but just, yeah, that's the way that you would look at yields, is it's one piece in the puzzle. And if income is more important to you in terms of what you want to have out of your investment, then it would make sense to look at that one.
Thanks, Michelle. I found that very helpful, so I hope our listeners did also. We don't have any other questions at this time, so guys, if you have any other questions, we'll just give you 1 or 2 minutes to pop them into the question box. So please do that. Michelle, I just have while we're waiting to see if anyone have any more questions, do you guys have any plans to introduce any new offshore exposure to the CoreShares range going forward?
We do, Sean. We have a very we always have a lot of energy about looking at what we still think would make sense in the South African market and what South African investors need. And so yes, we will. Please watch the space. We should have some new products coming to the market next year. And obviously, I'm not going to spoil the surprise for you. Yeah, there's some interesting regulatory changes that may or may not be happening at the moment. And yeah, I think we'll continue to see more range, more products in the range for South Africans in terms of ways to access offshore exposures.
Yeah, awesome. That's really great to hear. I mean, I know that we have up at 78 ETFs on the JSE, and like I spoke about how many there is overseas in that. So it's always good to hear that there's more range and more scope for people to look at and get into. We got just a question asking about the minimum. So on EasyEquities, there are no minimums. You can start with as little as R5. But obviously, it's whatever you can invest and what you want to do. Okay, so we just got one more coming in here, Michelle, is what is your general view on property growth globally and in South Africa over the next 12 to 24 months?
So thank you for that question. Unfortunately, I don't have a crystal ball. And as I said, we at CoreShares, we don't have a house view on, we don't have a team of analysts that look at the economy and give a house view. What I will say is that, we have conversations with lots of different types of investors, particularly on South African property. And in the South African property space, we've got a lot of the investors who we speak to are still very nervous about it. They're not, it seems very polarized. So they are out of it. They're not looking to get back in yet. They're still a bit nervous. And on the other hand, we've got some people starting to talk to us who think that, the price is reflecting most of the bad news, and that there is upside from here. It's very, 12 to 24 months is a very short-term view. That's very speculative. It's very hard to get those kind of calls right. And what we found, that's what's, we sort of tend to call that tactical asset allocation. So when you go and speak to a financial advisor or, try to look at an asset allocation, get somebody who advises you on the right asset allocation that suits your goals. What they tend to have is long-term asset allocation. So saying, based on your goals, you need to have this much in equities and this much in bonds and this much in property, et cetera, based on your personal financial situation and the goals that you want to try and reach. And those are sort of long-term views. And then what some asset managers do is they try to do tactical. So they try to say, well, actually, I think that equities are going to do better, and it's time to be more overweight in equities than what your sort of long-term asset allocation suggests. Or I'm really worried about a crash. I'm going to sort of do underweight equities and property. I'm going to put everything in bonds. And that's called tactical asset allocation. That is about trying to predict, trying to forecast what is going to happen in the next year. And when we looked at this, we looked at all the sort of balanced funds, so the multi-asset funds in South Africa, and we actually found that those managers, if they would have just stuck to their stated strategic asset allocation, so just what they said was the right asset allocation for the particular goal, with the different building blocks that they've used to build the strategy and just stuck to that, their performance would have actually been better than the fund managers that used tactical asset allocation. So the fund managers that try to say, I have a firm view on what's going to happen in the next 12 months. And so they actually overall, as a whole category in the multi-asset space, their performance was worse by trying to do this tactical asset allocation. So based on that, we as a house steer away from that, and we actually, our investment philosophy is all about just deciding on your long-term goals and then having an asset mix that would deliver that to you with a high degree of probability. And so we do actually have property in our multi-asset. We've got 2 multi-asset funds that are in unit trust format. CoreShares Wealth Accumulation, which is our high equity fund, and a CoreShares Stable Income, which is a low equity fund. And we do have an allocation to property in both of those funds, simply because of this attractive income characteristic. So particularly in the Stable Income Fund, which is the low income fund that's designed for people that are in retirement and living off the income from the investments. And so we had property in before before the events of this year, and we still continue to hold it because over the long term, coming back to this, where's my little graph here? Over the long term, this is what property can bring to a portfolio, and that's always our investment philosophy at CoreShares, is that we make decisions based on evidence, based on data, and based on academic research. So we don't try and predict. And it's not to say some people are good, some people do get it right, but on average across the industry, people are not very good at getting that right. So yes, I'm sorry, I know I didn't answer your question, but I think it just talks to sort of the more long-term nature of financial goals.
Great, thanks a lot, Michelle. And I think you didn't maybe answer specifically, but you spoke really well about what was going on there and giving people more insight into that. So thanks a lot. There aren't any other questions at this time, and I think we're going to just call it there for now. So thanks. Thanks again, Michelle, I think it was an amazing presentation. It's always lucky to go into depth about the different instruments and also find out exactly what's going on in the offshore market. So thank you very much for sharing your insight and time with us today. And thank you to all our guests and guys for listening in. I hope you really enjoyed it and found it as insightful as I did. I mean, I've been listening, obviously been involved in the whole CoreShares series, but I've learned a lot over the series, and I hope you guys have also.
Thanks so much, Sean. Thanks for having me, and thanks to everybody for tuning in.
Always a pleasure, Michelle, and looking forward to the next one. Guys, please make sure to check it out. It'll be up on our EasyETFs platform to register for it soon, so please make sure to check it out there and register for the webinar. Have a great day.
Bye.